U.S. labor market is at a crossroads. August's job report showed a slowdown in hiring, with only 142,000 jobs added versus the expected 160,000. This marks a continuation of the weaker job growth trend we've seen this summer, with revisions reducing job gains for both June and July. This reflects a labor market that is cooling down after 2 years of post-pandemic recovery. However, despite the decline in job creation, the unemployment rate held steady at 4.2%, signaling a labor market that remains relatively stable despite these headwinds. Wage growth also ticked up, with average hourly earnings rising by 0.4%, slightly above expectations. This suggests that while the job market may be softening, workers are still seeing income gains, which can support consumer spending and prevent a sharp downturn in the economy. The Federal Reserve is now in a delicate position. With job growth slowing but inflation still a concern, the Fed must decide its next move carefully. Market analysts are increasingly expecting the central bank to cut interest rates by 50 basis points at its upcoming September meeting. The Fed has been raising rates aggressively over the past year to combat inflation. But with job creation slowing, some argue that rate cuts may be necessary to avoid tipping the economy into a recession. However, the Fed must also consider inflation, which has been persistent despite its efforts. The challenge lies in finding a balance between curbing inflation and supporting a weakening labor market. If the Fed acts too quickly in cutting rates, it could reignite inflationary pressures. If it waits too long, the economy might slide into a recession, driven by the weakening labor market and high borrowing costs. At the same time, global trade dynamics are becoming increasingly complex, particularly between the U.S. and China. The ongoing rivalry between these two economic superpowers continues to strain global trade systems. However, global trade has shown surprising resilience despite the pressures from tariffs, sanctions, and economic nationalism. Recently, we've seen a strategic shift in how Chinese companies navigate Western markets, finding ways around tariffs and other barriers by setting up operations in different countries. This shift highlights how global companies are adapting to new challenges in trade relations. In the broader context, globalization is evolving, with more state intervention in economies worldwide. Countries are adopting protectionist policies to secure their interests, particularly in critical industries like semiconductors, green energy, and strategic technologies. As the U.S. and China continue to compete for dominance in these sectors, the global economy may face new patterns of trade and investment. Given all these factors, the slowing labor market, the Federal Reserve's balancing act, and global trade uncertainties, many economists are preparing for a potential U.S. recession later this year. While the downturn may not be as severe as past recessions, the signs are clear that economic conditions are deteriorating. Investors, businesses, and policymakers will need to stay